Hi, my name is Jordan Wilson. We just finished a fairly comprehensive look at the dollar cost averaging versus lump sum investing debate. I think there's pros and cons to both, but overall, I tend to fall more in the dollar cost averaging side, especially for smaller investors that need to build portfolios over time. Today, we're going to shift into another debate: the usefulness of a buy and hold investment strategy. And this is more, you're using dollar cost averaging, say, or lump sum, to make your purchases on a periodic basis. But you also need to review and adjust your portfolio. Should you maintain a buy and hold where you don't touch anything? Or do you actively trade? And that's kind of what we'll look at in the next few episodes. The first option you have is what we call a buy and hold strategy. And that is pretty much exactly as it sounds. You identify an asset, you buy it, and you hold it over the investment time horizon. If you're 25 years old and you like Coca-Cola shares, you invest at 25 and perhaps you don't sell until you retire and need the cash flow from the gains over time. So that might be a 40, 50-year time horizon. On the other extreme, you have what's called high frequency trading, also known as day trading. And again, as the name suggests, you're going to be a very active investor. On the one hand, you could trade multiple times of Coca-Cola in the same day, buying and selling, trying to take advantage of small price discrepancies. But even if you don't trade on a daily basis, you're still relatively active. Maybe you're trading Coca-Cola every month or two. We would call that still active. A lot of high frequency or day traders rely on technical analysis, so software that gives them buy and sell signals. And as we'll see, that's really not for the weak of heart as an investor. In between day trading and buy and hold, we tend to find most of the investor class. And how frequently you trade largely depends on who you are as an investor. And that's your investor profile. What's your investment experience? What's your knowledge? How much time do you have available to research and monitor your portfolio? What's your risk tolerance? Your investment objectives, constraints, your personality, the time horizon. Do you have 50 years to hold on to your Coca-Cola shares? Or do you need to sell them in 6 months to buy that house? So again, time frame. And then just the general economic conditions. Some people may be more actively trading in a bull market than in a bear market. Other people may be the complete opposite. And then the final aspect would be investment volatility tends to factor in. If you're in a plain vanilla Standard & Poor's 500 ETF, you probably don't need to trade that as actively as if you're trading shares of Tesla or Facebook or buying and selling Bitcoin. Now, my thoughts on this: I would avoid day trading. There's not really a high success rate. Many day traders require relatively substantial amounts of capital. And in many ways, it becomes a full-time job. And for many day traders, it is a full-time job. Not to mention, it can be quite stressful, especially in down markets. If you want to do some active trading, sort of that in-between section that we just discussed, I think that can be useful for individual assets, non-diversified assets. Again, shares of Coca-Cola, shares of Google, an individual Government of Canada long-term bond. So things that are not diversified as a holding themselves, you do want to monitor more closely, and you may have to adjust through trading to get back on course. Also, the more volatile assets, options, commodities, the greater the risk inherent in an investment. And by risk, we're talking the price volatility. The more you have to monitor and deal with it. So you can't be a buy and hold person if you're trading higher risk, higher volatility assets. And then finally, the buy and hold. I think that fits very well with the passive investing approach that I've discussed in the episodes leading up to today. It works very well for diversified investments, such as low-cost index funds, ETFs. And we just saw that within an index itself, as new up-and-coming companies come in and improve their fortunes, they're added to an index, and they're replacing a company that's on its way out. And we just looked at the rise and fall of a company like Eastman Kodak that came on the exchange, or the Dow Jones 30, in 1930. And in the 70s, it held market shares in its two main classes of 85 and 90%. Yet by 2004, their fortunes had fallen. They were taken off the Dow 30, and they went bankrupt in 2012. Conversely, we saw that Apple Computer in the 80s was a penny stock. They fired Steve Jobs as CEO. They brought him back in 97. Fortunes turned around. They started entering various indices. And in 2015, they were added to the Dow 30. 30 of the, let's say, most prestigious companies based in the US. So from a penny stock in the 80s to one of the top 30 perceived companies in a short time span. So again, you're buying and holding, but the underlying assets within an investment change. So I think that's where buy and hold is good for diversified investments, and if you're in a passive investing approach, because it will be cheaper than incurring transaction costs if you're making multiple trades in a single day. Over the next few episodes, we're going to focus on buy and hold. We'll look at the advantages, at least the advantages as I see them. We'll look at some of the disadvantages, both the perceived, things that maybe I don't think are legitimate complaints, but that you will read or see on YouTube from people that do not like buy and hold. We'll also look at what I think are legitimate criticisms of buy and hold. And then we'll move into sort of considerations, or maybe how to address some of what are the legitimate concerns. How can you tweak, let's say, buy and hold to deal with market volatility? Can you use buy and hold with individual, non-diversified assets? And yes, it is called buy and hold, but you need to review. Regardless, you need to review your investor profile on a periodic basis to make sure that your personal circumstances that are driving your target asset allocation are still applicable to that target asset allocation. You need to look at the alignment with the target asset allocation. If you have 30% targeted to US domestic equities, and suddenly you're at 45%, then your risk return profile is out of alignment with your target. So you need to make some modifications. You also need to look at the quality of the individual holding. When we choose investments for our portfolio, we want to choose quote unquote best in class. Yet every year new products come out with new pricing. If you bought that high quality index fund in 2000 or 2010 and you don't review it against its peers on a periodic basis, maybe that best in class fund that you bought 15, 20 years ago is now in the lower quartiles as far as its performance or its costs. So yes, you want to buy and hold if you use a buy and hold system, but you need to always review. And that review may lead to modifications. In short, that's sort of what buy and hold is about versus the other options. And as I say, we'll look at the advantages, the disadvantages, the considerations over the next few episodes. Thank you for your time today. Have yourself a good one, and we'll come back next week with buy and hold advantages.